In episode 5, we discovered that every major DeFi protocol runs on a single equation: Uniswap's constant product hyperbola, Curve's flattened StableSwap, and Balancer's weighted geometric mean. Beautiful curves. But we left 3 questions unanswered. First, Uniswap V3 lets you concentrate liquidity into a price range. What does that do to the math? Second, lending protocols like Aave use a kinked interest rate curve. Why does the rate explode above 80% utilization? Third, if prices live on a bonding curve, can an attacker manipulate the oracle by simply trading? Today, we solve all 3. And we will discover that every one of these DeFi mechanisms is a trade-off curve between bias and variance, the same trade-off that governs regularization in machine learning. In episode 5, we showed the constant product curve, xy equals k. An LP's capital is spread across every possible price from 0 to infinity. But most of that capital sits idle. Uniswap V3 changed the game. An LP now chooses a price range, PA to PB, and concentrates all their capital into that slice. The key parameter is L, the liquidity. Think of L as the thickness of the curve within your chosen range. Mathematically, V3 uses a translated hyperbola. The real reserves X and Y are shifted by virtual reserves, L over square root of PB and L times square root of PA. The actual tokens you hold depend on the current price P. As P moves toward PB, you hold more and more of token Y. As P moves toward PA, you hold more token X. And if P leaves your range entirely, your position becomes single-sided and earns 0 fees. Now here's the punchline of concentrated liquidity: capital efficiency. The multiplier E measures how much more depth your V3 position provides compared to V2 for the same capital. For our ETH USDC example, with a range from 1,500 to 2,500, the V2 value per unit L is about 89.44, but V3 needs only 10.71. That is an efficiency of about 8.4 times, and it scales dramatically. A narrow 5% range gives 40 times efficiency, a 1% range, 400 times. And Uniswap's famous 4,000 times headline corresponds to a range just 0.1% wide. But there is a deeper cost that most explanations miss. In 2022, Milionis and co-authors derived what they called the Black-Scholes formula for AMMs. Loss-Versus-Rebalancing, or LVR, measures the continuous cost of committing to a bonding curve. For a V2 pool, LVR equals 1/8 of sigma squared times the pool value. This is not impermanent loss. IL can reverse if prices come back. LVR never reverses. It is a monotonically increasing cost, the option premium an LP gives away by pre-committing to the demand curve. And here's the trap that many introductions skip. V3 IL equals E times V2 IL. A position that is 8.4 times more capital efficient is also 8.4 times more exposed to impermanent loss, while the price stays in range. A 50% price move costs a V2 LP about 2%. The same move costs a V3 LP nearly 17%. Concentrated liquidity is a double-edged sword. Now let us make the option selling analogy rigorous. The value of a full-range LP position is V equals 2L square root of P. This is a power option with exponent 1/2. Notice the shape. It curves below the straight HODL line. That concavity is the entire story. Take the first derivative, delta equals L over square root of P. This is exactly X of P, the amount of token X the LP holds at price P. Your delta is your reserves. Now the second derivative, gamma equals negative L over 2P to the 3/2. This is strictly negative for every positive price. The LP is always short gamma. In the language of episode 11, that means the LP is selling volatility. In 2020, Tassi and White proved that LP cash flows in a feeless constant product market are asymptotically equivalent to a continuously rebalanced short straddle. An option buyer pays an upfront premium and receives positive gamma. They profit from big price moves. An AMM liquidity provider pays a continuous LVR cost and receives negative gamma. They profit when prices stay calm. A year later, Andreas Evans and Chitra proved something even deeper. Every monotonic payoff is replicable by an LP share in some CFMM. AMMs are not just like options, they are options. Here is the key sentence to take away. Buying an option pays an upfront premium for positive gamma. Providing AMM liquidity pays a continuous LVR premium for negative gamma. Now that we understand the option economics of AMMs, let us turn to a completely different DeFi building block: lending protocols and their interest rate curves. Now for the second unsolved problem from our opening. In a lending protocol like Aave, interest rates are not set by a market. They are set by an algorithm. The input is utilization, U, the fraction of the pool that is currently borrowed. The borrow rate follows a piecewise linear function with a kink at the optimal utilization, U star, typically 80%. Below the kink, rates climb gently. At 80% utilization, the borrow rate is just 6%. But cross that threshold, and the slope explodes, 75 times steeper. At full utilization, the rate hits 81%. The kink is an economic signal. Do not let the pool run dry. But what happens when a borrower cannot repay? That is where the health factor comes in. The health factor is the ratio of collateral value, weighted by liquidation thresholds, to total debt. Take our example. 10 ETH at $2,000. Liquidation threshold 0.825, against $12,000 of debt. The health factor is 1.375, safe. But if ETH drops to around $1,455, the health factor hits 1.0, and the position gets liquidated. A liquidator repays up to half the debt and receives the collateral plus a 5 to 10% bonus. Now here is the wild card, flash loans. You can borrow any amount with zero collateral as long as you repay within the same transaction. The fee in Aave V3 is just 0.05%. $1 million flash loan costs $500. Flash loans decouple capital from leverage. They are zero-cost probes of the entire DeFi state space. This will become critical when we discuss oracle manipulation and sandwich attacks. But first, let us tackle the most elegant piece of DeFi mathematics, the curve StableSwap invariant. Now for the most elegant piece of mathematics in DeFi, imagine you are designing an exchange for stablecoins. You have two endpoints. On one extreme, the constant sum, x plus y equals d, a straight line, zero slippage but no price discovery at all. If one token depegs, the pool drains completely. On the other extreme, the constant product, xy equals k, a hyperbola, maximum price discovery but terrible slippage for tokens that should trade near 1-to-1. In November 2019, Michael Egorov found a way to interpolate between these two extremes. He introduced a dynamic weight chi that depends on how balanced the pool is. When the pool is perfectly balanced, chi equals a, the full amplification coefficient, and the curve looks like a line. When the pool becomes imbalanced, chi drops towards zero, and the curve reverts to a constant product hyperbola. The result is the StableSwap invariant, a single equation that blends constant sum and constant product using the amplification parameter a. One important notation trap. An to the n means a times n to the power n, not a times n times n. For two assets, both give the same answer, 4a. But for three assets, the difference is 27a versus 9a. Getting this wrong breaks the entire calculation. Now watch what happens as we sweep a. At a equals 1, the curve looks almost like Uniswap. At a equals 10, the middle 30% flattens out. At a equals 100, the standard value for established pools, the curve stays flat all the way to a 75-25 imbalance. And at a equals 1000, it is nearly a straight line until 95-5. The impact on slippage is staggering. In a $10 million pool, swapping $100,000 on Uniswap V3 costs 99 basis points. The same swap on curve with a equals 100 costs just half a basis point, 200 times less slippage. At a equals 1000, it is 0.05 basis points. In 2021, Curve released a second version, CryptoSwap, that makes the reference price dynamic, essentially StableSwap with a movable origin. But that is a story for another episode. Next, what happens when someone exploits the very bonding curves we have been studying? So far, we have studied protocols as if transactions happen in a fair queue, but in a permissionless blockchain, whoever orders the transactions extracts a rent. This is called maximal extractable value, or MEV. In 2020, Dayan and co-authors documented how bots compete to reorder, insert, and censor transactions for profit. Three main strategies: front-running, back-running, and the combination, the sandwich attack. Here is how a sandwich works. Step 1. The attacker sees your pending trade in the mempool and buys the same token right before you, pushing the price up. Step 2. Your trade executes at the now inflated price. Step 3. The attacker sells immediately after, pocketing the difference. The profit, to leading order, is the victim trade size squared divided by 4 times the pool depth times the price. A $50,000 trade in a $5 million pool yields about $125 before fees. The key insight? Profit scales quadratically with victim size and inversely with pool depth. But sandwich attacks are not the only way to exploit these curves. Uniswap's on-chain price oracle stores a time-weighted average price, the TWAP. Angeris and Kitra showed that the cost of manipulating this oracle grows linearly in pool depth and linearly in manipulation duration. This is why deep liquidity is not just good for traders. It is the security model for every protocol that reads prices from a Uniswap pool. Thin pools have been exploited repeatedly. Mango markets in 2022, BZX in 2020. Finally, MEV is not limited to two-party attacks. A cyclic arbitrageur routes through multiple pools in a single transaction. The profitability condition is a product of price ratios across all pools, net of fees. Combined with flash loans, this becomes a zero capital optimization problem. The annual MEV on Ethereum alone is estimated in the hundreds of millions of dollars. Every DeFi protocol we have studied so far works in isolation, but modern DeFi is recursive. You stake ETH, receive a liquid staking token, wrap it, deposit it on Aave as collateral, borrow against it, swap on Uniswap, and deposit the result somewhere else. Each link in this chain adds a multiplicative assumption. The probability that the full chain stays solvent is the product of each link's reliability. Even if each link is 99% reliable, a chain of 10 links has only a 90% chance of staying solvent. This is the formal version of DeFi Lego risk, and when one link breaks, the damage cascades. A price drop pushes health factors below 1. Liquidation sell collateral. The selling pushes prices lower. More positions fall underwater. More liquidations fire. It is a self-reinforcing crash. This is exactly what happened on Black Thursday in March 2020, when MakerDAO nearly collapsed, and again in April 2026, when the Kelp Arseth bridge exploit caused Aave's TVL to drop from $26 billion to $20 billion in just 24 hours, leaving roughly $196 million in bad debt. But the most dramatic example is Terra and Luna in May 2022. UST was an algorithmic stablecoin. One UST could always be exchanged for $1 worth of Luna. But this means the new Luna supply equals the old supply plus the amount of UST burned, divided by the Luna price. If the Luna price falls towards zero, this fraction diverges. More Luna must be minted, which pushes the price even lower, which requires even more minting. Luna's supply exploded from 350 million to over 6.5 trillion tokens. About $40 billion of market value was erased in less than a week. One crucial distinction: algorithmic stablecoins like UST are not the same system as fully collateralized stablecoins traded in a curve pool. Different mechanisms, different failure modes. Do not confuse them. With all of these tools now in our hands, let us step back and see the deeper pattern that connects everything. And now, the pattern that connects everything. On the left, DeFi. The StableSwap amplification coefficient A controls how aggressively the curve flattens near the peg. A near zero, constant product, high variance. Tiny imbalances cause huge price moves. A near infinity, constant sum, high bias, no price discovery at all. On the right, machine learning. L2 regularization adds lambda times the squared norm to the loss function. Lambda near zero, overfit, high variance. Lambda near infinity. The model collapses to a constant, high bias. The mathematical signature is identical. Both are convex combinations weighted by a hyperparameter. Both trade-off fit versus robustness. Choosing the optimal A for a curve pool is formally the same problem as choosing the optimal lambda for a regression model. And this is not the only bridge. LVR maps to exploration cost. Flash loans map to zero-cost probes. Concentrated liquidity maps to kernel bandwidth. The kinked Aave rate curve is a real U activation, and a sandwich attack is an adversarial example. The financial system is reinventing the same mathematics that the machine learning community has been formalizing since the 1990s. The vocabulary differs. The equations are identical. Next time on the math behind finance, calibration. From theory to practice, fitting models to market data.